Hello students, welcome to the ongoing lecture series on international business. We were discussing the theories of international trade and this is Theories of International Trade part 3. I am Professor Shoma Sengupta, Kamla Nehru College, University of Delhi. In this lecture, we will discuss the Leontief paradox, Linder's income preference similarity theory. The Leontief paradox. This theory was propounded in 1953 by Wassily Leontief. Leontief observed a strange phenomenon as he was studying the import and export composition of United States of America. So he found a strange phenomena and discussed that in this theory. The paradox contradicts Heckscher-Ohlin factor endowment theory that we have studied in the last lecture. Now, the factor endowment theory given by Heckscher-Ohlin, or which is known as HO theory, it suggests that countries will export goods that require the intensive use of their relatively abundant factors of production. So, if a country is having more of capital, then it will use capital intensive products, manufacture or use it in the production of capital intensive products. Or if it has labor in abundance, it will go for labor intensive technology and labor intensive products. Countries will import goods that require the intensive use of their relatively scarce factors. So, suppose we take the example of India after independence, what was scarce was capital and what was in abundance was labor. So, India exported or produced the products which are labor intensive and used to import the goods which were capital intensive or used more of capital, and this phenomena continued for a long period of time during the 60s and the 70s till the 90s. And when we became a self-reliant in terms of capital also, then we started manufacturing both capital intensive goods as well as labor intensive goods. So, the Heckscher-Ohlin theory suggests that you will produce those products in which you have certain advantages or factor endowment advantage is there in that country. Now, Wassily Leontief found that a strange thing in United States when he studied the exports and import composition of United States over the years. So, despite being capital abundant, it exported goods that were more labor intensive than its imports. The finding was unexpected as it contradicted the Heckscher-Ohlin model's prediction. So, the prediction would have said that since United States is capital abundant, then it will export all capital intensive products and it will import labor intensive products. But what they found that if the composition is studied in detail, what they are exporting, that is more of labor intensive products, and what they were importing was more of capital intensive products. Now, since the finding of Leontief was unexpected as it contradicted the Heckscher-Ohlin model's prediction, it is called a paradox. Let's study the case in detail. So, US has abundance of capital. It is assumed that US would be the exporter of capital intensive goods. So, if we compare the figures of export and import from US or to US, then what we expect is the export of capital intensive goods will be more and less of the labor intensive products, and what they will be importing is more of labor intensive products and less of capital intensive products. In reality, US exports less of capital intensive goods when we compare it with what they are importing. So, if we see the figures in this table, we find that this table shows the capital and labor proportion of US exports and imports in 1947. If we see the export figure, capital in US in dollar, it is 25 lakh 50,780 and imports is more, that is 30 lakh 91,339. If we consider the labor in worker years, it is 182 for exports and 170 for imports. And capital for worker year, if we find out, then we find that in exports it is 14,105, but in imports it is much more, that is 18,184. So, it means that it was importing more of capital intensive products and exporting more of labor intensive products. So, these figures and the explanation are contrary to the predictions of the factor endowment theory or the HO theory, and as we have said that it is called Leontief paradox. Now, let us explain what happens in case of Leontief paradox. So, the explanation goes like that Leontief used import substitutes, which is not considered by HO theory. The factor proportion in the manufacturing industries may be different from that found in USA for same industries. Differences between skilled labor and unskilled labor is there. So, USA had an advantage in the production and exports of goods that required skilled labor and innovative entrepreneurship like software. So, this is contradictory to what they have expected. So, skilled labor is very important. Did not consider natural resources. The HO model does not account for natural resources, which play a role in trade patterns. While in Leontief paradox, we are also considering the natural resources. Resources are used together with capital. A country is importing capital intensive goods may be actually importing goods that involved intensive use of natural resources. So, both the things are important. Then importance of natural resources is also there because Leontief considered only capital and labor inputs, leaving out natural resources inputs. Natural resources and capital are used together in production. A country that imports capital intensive goods may actually import natural resource intensive goods. For example, US imports crude oil. So, if we see the budget of imports of US, it is going for crude oil also. So, which is one of the natural resources. Technological differences are to be considered. The US might have a technological advantage in certain industries, leading to exports of goods that are not necessarily capital intensive. Then another point which was explained in Leontief paradox was existence of trade barriers. Differences in trade barriers and other regulations between countries can also influence trade patterns. For example, USA could not import much of the labor intensive goods because of the trade barriers present there. Human capital should also be considered. The US may have a comparative advantage in goods requiring skilled labor, which is a form of human capital rather than just physical capital. In reality, there are differences in the technologies among the countries. This leads to differences in productivity and patterns of international trade. Also, US has a demand bias for capital intensive goods. Now, when such type of situation is there, it reverses the US comparative cost advantage in the production and export for such goods. So, they have a knack of importing more and more of capital intensive goods because they have a demand bias. So, when we talk about automobiles, the Japanese automobiles, they are selling in USA and they are importing it from Japan. So, that increases the capital intensive goods import in USA. Factor intensity reversal also takes place. This reversal occurs when the relative prices of labor and capital changes over time. So, you see that the relative price of labor and capital will undergo change over a period of time, and that will show a reversal in the composition of export and import of a country. So, these changes this changes the relative mix of capital and labor in the production process. So, when labor becomes expensive, so more of capital will be used, and when the capital is expensive, then more of labor will be used. Then the relative mix of capital and labor in the production process of a commodity changes from being capital intensive to labor intensive or vice versa. So, these are the explanations of Leontief paradox. Now, we move on to the merits of the Leontief paradox. This model highlighted the limitations of other models, especially the Heckscher-Ohlin model. The paradox highlighted the limitations of Heckscher-Ohlin model. It spurred further research into the complexities of international trade. Importance of non-abundant factors were highlighted by Leontief paradox. So, the HO theory, in which it was said that if you have abundance of one factor, you will concentrate on that factor and you will have that type of technology in production of goods. But this model or Leontief paradox demonstrated that factors beyond simple factor abundance can also influence the trade patterns. So, these were the merits, but there are certain limitations of Leontief paradox. No conceptual background. Leontief attempted to explain his test verbally, augmenting the idea of using the equivalent worker unit. So, much of research was absent in case of Leontief paradox. Facts and figures were not given, or a detailed study was not done. Other researchers came out with models to explain it. So, for example, Daniel Treffler in 1993 creatively extended Leontief's idea to a factor specific model to measure the trade pattern by effective endowments. Another study was conducted by Fisher and Marshall in 2011, which suggested the virtual endowments of the general technological differences to test trade patterns. So, other researchers, they came out with certain explanations for Leontief paradox, but Leontief as such did not give much of explanation for why this type of phenomena was happening, or facts and figures were not there. So, validity was questionable of Leontief paradox. Now, coming to the next theory which we are going to discuss in this lecture, it is Linder's income preference similarity theory. So, it is one more interesting theory to explain international trade. The Linder hypothesis was proposed by economists Stephen Burenstam Linder in 1961 as a possible resolution to the Leontief paradox. The Linder hypothesis states that the more similar the demand structures of countries, the more they will trade with one another. Now, you can see some similarity in the developed countries. So, if in underdeveloped countries there are certain similarities. Likewise, in mid-segments countries there is another kind of demand pattern or some similarities. Even region wise also there is a differences, and this is also because of the income pattern in that particular country. If we take the example of the South Asia, the income pattern is quite different from what is there in Western Europe. So, in South Asian countries, the demand pattern or preference pattern is different from what is there in West European country. Likewise, we can divide the countries on the basis of income and find out some kind of similarity in their preferences for different type of products. So, this was the Linder's hypothesis. This will happen as the countries are relying on specialization to create a comparative advantage in the production of differentiated goods between the two nations. Hence, trade potential between nations depends on similarity of demand preferences for different goods, especially manufactured goods. The more similar the demand preference for manufactured goods in two countries, the more intensive is the potential trade between them. So, for example, when television came into picture, it was invented. So, we find that the Western world, they adopted that technology earlier than other regions. Why? Because they have the similar kind of income, so they could afford that product. Likewise, the same is the case with telephone, or the case with any other equipment like smartphones or a PC or a laptop. So the things are first introduced when they are highly priced in certain countries which have higher income. So because of that, they have similar type of income preference, and that's why it is known as income preference similarity theory. If two countries have the same or similar demand structures, then their consumers and investors will demand the same goods with similar degrees of quality and sophistication. Now, you will find even the products, they differ in general world. If you see, the product manufactured for higher income countries is little different from the goods which are the same product which is manufactured for less developed countries or less income countries. Why? Because in those countries where the income is higher, they can afford to have that kind of quality product. But the less developed countries, the people over there might not afford that kind of product. Even in case of chocolates by popular brands, when you go to Western Europe, the product quality is better, the price is higher. But the same brand, even when it is selling in the Eastern European countries, you will find the quality is a little inferior and the prices are lesser in comparison to in what price they are selling in the Western market. Likewise, when it is available in say for example Kit Kat in India, you can buy a Kit Kat at a very lesser amount, say 20-25 rupees, but if you are buying an imported Kit Kat, that is very expensive, and the lesser quality variety is not available in the developed countries. Same is the case with other manufactured goods. This is known as preference similarity. This similarity boosts trade between two industrialized countries. The most important determinant of demand was average per capita income. Countries with high per capita income will demand high quality luxury consumer goods, example automobiles, and sophisticated capital goods, example telecommunications equipment. So there is much more demand, higher demand of these type of products of superior quality, high price products in the countries which have a very high per capita income. But when compared it with that, the low per capita income countries, they will demand low quality, necessity consumer goods, for example, bicycles, and less sophisticated capital goods, example, food processing machinery. So, the products which will be selling in these countries will be different. And you can categorize the countries on the basis of low per capita income, and you will find a similarity in the demand pattern or preference in these countries. Rich country that has a comparative advantage in the production of high quality advanced manufactured goods will find big export markets in other affluent countries where people demand such products. Manufactured exports of the poorer countries will find their best markets in other poor countries with similar demand structures. So, we find that even when we are exporting some of the products, they are selling in those countries which are either at par in terms of per capita income of our country, or they are poorer than us. So, when we talk about, say, we visited once to Parle G factory and they said that we have manufacturing unit or we are exporting to other countries like other countries of Asia and Africa. So, they are not exporting it or not having a manufacturing unit in the Western countries or the more developed countries. So, this kind of phenomena happens because of this income preference similarity theory. The effect of per capita income levels on trade in manufactured goods is affected by entrepreneurial ignorance, cultural and political differences, transportation costs, and obstacles like tariff barriers. Now, what are the merits of Linder income preference similarity theory? Now, this is a very general theory and but it is touching a very important phenomena. It presents a possible resolution of the Leontief paradox. So, Linder proposed an alternative theory of trade that was consistent with Leontief findings, that even a country like US may be importing more of labor intensive products or exporting less of capital intensive products. Demand based theory, we can consider this Linder income theory, because there is a demand for certain kind of products in a particular country, they will sell in that country. So, the Linder hypothesis presents a demand based theory of trade in contrast to the usual supply based theories involving factor endowments. So, if high quality labor intensive products are required in USA, so that is the explanation. It is not about the low quality products which will sell in USA, but high quality labor intensive product. Why? Because they are expensive, although they are labor intensive, but since it is a skilled labor is involved, they are expensive, and that is being imported by US. Linder hypothesized that nations with similar demands would develop similar industries. These nations would then trade with each other in similar but differentiated goods. So, we find most of the trading is happening between the EU countries, because the European Union countries are similar in terms of their income, in terms of their demands, and that is why similar type of industries are growing and they are doing business among themselves. Then this is an empirically tested theory. Examination of Linder hypothesis have observed a Linder effect consistent with the hypothesis. Econometric tests of the hypothesis usually proxy the demand structure in a country from its per capita income. It is convenient to assume that the closer are the income levels per consumer, the closer are the consumer preferences. Now, what are the limitations of the Linder income preference similarity theory? Though empirically it has been tested, the validity is questionable. It is difficult to test the validity. This is because countries with similar level of per capita income are generally located close to each other geographically. So, they can be taken as one whole area like the European Union. While the distance is a very important factor in explaining the intensity of trade between the two countries. Also, the Linder effect has been found to be more significant for trade in manufacturers rather than non-manufacturers. So, they are concentrating on manufactured products. Within manufacturers also, the effect is more significant or for trade in the capital goods than in consumer goods. Also more significant for differentiated products than for standardized products. So, let us summarize this lecture. Leontief paradox was propounded in 1953 by Vasily Leontief that contradicts Heckscher-Ohlin factor endowment theory. Leontief found that the US, despite being capital abundant, exported goods that were more labor intensive than its imports. As this theory is contrary to the predictions of the factor endowment theory, hence it is called Leontief paradox. The explanation was that the HO model does not account for natural resources, import substitutes, skilled unskilled labor and technological differences. The Leontief paradox highlighted the importance of non-abundant factors and demonstrated that factors beyond simple factor abundance can influence trade patterns, but the paradox had no conceptual background. The Linder hypothesis was a possible resolution to the Leontief paradox. It states that trade potential between nations depends on similarity of demand preferences for different goods, especially manufactured goods, and this is a kind of a solution to the Leontief paradox. These are some of the references. C.B. Gupta's book, Sumati Verma's book, Hill and Hult book is there. Thank you students. Have a nice day.